Welcome back to another episode. I'm going to talk about something today that I haven't talked about before on the podcast. And I went back through all of the well over 100 episodes that I've done, not believing how could I have never talked about this. Maybe I've mentioned it in passing, I'm sure I have, but I've never really focused on it. And it's, I think, somewhat crucial in the big financial picture. And I also wrote a column on it a few months ago. And the question that I posed is your financial advisor a fiduciary? And the answer is probably, because it's hard not to find an advisor that has a fiduciary standard. And basically, a fiduciary standard is one of putting the client's interests first. Back in the day, it was kind of a rarity. It was the gold standard of something you wanted to be sure that your financial advisor is a fiduciary. As regulations have proceeded and like the CFP Board of Standards has advanced, today, if you're a registered investment advisor, which is an RIA, if you accept any type of fee, no matter how small it is, you are held to a fiduciary standard. And even RIAs that are 100% commission are held to a fiduciary standard, that is putting the client's interests before yours. Now that sounds pretty good. I mean, if the advisor is putting my interest first, what more could I ask for? And in a way, that's true. The question is, are they really putting your interests first? And how can you know that they're putting your interests first? Especially if they have a conflict of interest in how they are compensated. So that's my real focus on the session today, is that it's not enough to ask almost anybody in a professional capacity that's going to be giving advice, that you're going to, for what you presume or what you need to be unbiased advice. The question is always, what are the potential conflicts of interest that that professional has? So medical professionals are held to a fiduciary standard. And that I'd go beyond fiduciary standard to say this person is an advocate for the client, for the consumer, which is pretty strong. When you think of advocating for somebody, you're really putting yourself in their shoes. So the medical profession is held to that. And in a broad base, if your medical professional also owns or has an interest in the drug that they are prescribing to you, they have a conflict of interest. And I think for the most part that's not allowed, but there's loopholes here and there. But by and large, when a person has a financial interest in the thing that they're recommending to you, there is a possibility, if not a probability, that there's a conflict of interest. Others that are held to the same standard would be the legal profession. They are the ultimate advocates for their clients. And again, if they are recommending a client does something that would benefit or prosper them, there's a huge conflict, and you'd have to wonder, are you really getting a fiduciary, an advocate? Are you getting somebody who is more concerned about how they profit, even if the law says they have a fiduciary duty? So, what does all this have to do with financial therapy? Well, financial therapy is a pretty big tent because it has two words, financial and therapy. So it's the intersection of money and emotions. It's the intersection of financial planning and therapy or psychotherapy or mental health. And so it's really hard to separate financial planning from financial therapy. And I will also be quick to say that financial therapists are not inherently doing financial planning. In fact, I would say very few financial therapists do financial planning. Just like very few financial planners do financial therapy. I think I've mentioned before on the podcast, I have two firms. One is a financial planning firm, one is a financial therapy firm. Are they synergistic? Of course. But each does something very specific. So I find a lot of the people that come to me for financial therapy usually or request a financial therapy appointment. Sometimes they'll request a financial therapy and a financial planning appointment. Typically, they would benefit from financial therapy first, financial planning later. And in many cases, if you're really stuck around some type of financial decision and just not making progress, it makes sense to me that we work on clearing up the blockage, clearing up the stuckness first. So then going to financial planning, the person is going to be in a position where they can absorb information much more easy, where they can have a higher probability of being in the action phase rather than in the pre-contemplation or contemplation phase of change. So I think financial planning is often in the future of someone doing financial therapy. For the most part, I would say it is. So it makes a lot of sense then that a person needs some education on what to look for in a financial planner, especially if they're coming from working with a financial therapist. Because a financial therapist is a fiduciary. They have the legal obligation to put their client's interest above their own. And if the financial therapist is a certified financial therapist, they inherently cannot be selling something or receiving commissions or incentives in any form. That's part of the standard. That's part of the review requirement. And if you think about it, if a person is really going deep with a client, really going back to the financial traumas that are really blocking them, it would be, the word disgusting comes to mind, if at the end of all that, then the financial therapist says, here's a product I think would help you, and they get a commission from selling that. Now, it's really important to make the distinction between a certified financial therapist and someone who calls themselves a financial therapist. Calling yourself a financial therapist is something anyone can do. And anyone can call themselves a financial planner. But not anyone can call themselves a certified financial planner or a certified financial therapist. So that's a place to start. And it's so important when you're coming from this container of advocacy in working with a certified financial therapist that you almost expect that type of advocacy, that type of quality, that type of safety in the engagement when you go to a financial planner. And the chances of getting that type of safety from a financial planner are actually much more remote than getting that from a financial planner, financial therapist. So that's kind of my lead-in, almost the whole podcast, of why you want to be sure that when you engage a financial planner, that A, they're actually doing financial planning, because anybody can call themselves a financial planner. So you've got to do some work to find out if they're really doing comprehensive financial planning. And the best way to do that is through an organization called NAPFA, the National Association of Personal Financial Advisors. Anybody in that group has been vetted to be doing comprehensive financial planning. The next thing, once you figure out, you determine, yeah, they're really doing everything. What is comprehensive financial planning? Well, it's evaluating all your insurances, it's evaluating your estate plan, it's taking a look at all your tax strategies and your tax returns, it's looking at your budgeting, it's taking a look at investments. Did I say estate planning? It's taking a look at everything financial in your life and coming up with a coordinated, integrated plan to address that. The second thing you want to be concerned about is, are they a fiduciary? Are they held to a fiduciary standard? Are they required by law to put your interests above theirs? Now, fiduciary started out to be something a little bit rare, and as the governments have been involved, it's now pretty ubiquitous. Almost everybody is a fiduciary that is a financial advisor, that is an RIA, registered investment advisor, as I said before. The thing to really focus on is, do they have a conflict of interest? Now, the CFP board says a CFP must disclose a material conflict of interest, which is pretty gray. So I want to focus on a conflict of interest, and you can make a case that every financial planner has some bias, some conflict of interest. But what I'm focusing on is a conflict of interest in how they are paid. In other words, that they receive some or all of their compensation via a commission of selling a product. And this is, there's so much distrust of financial planners for this reason. Let me give you an example. Recently, I wanted to sign up for a training, and it was actually an IFS training. And I've done a lot of IFS trainings, and of course, you're aware of my work in that and combining IFS with financial therapy and the fact that I'm a certified IFS practitioner. So I made application, and to my shock, I was refused. And I am not a licensed therapist, right? I am certified in the IFS protocol, but I am not a therapist. I think there's only 100 out of I don't know how many, potentially thousands. I can't put a number on it, of certified IFS people who are practitioners and not therapists. So it's a pretty small group of us. But anyway, I was shocked that I was refused. And the organizer said that they saw no connection between financial planning and the training that they're doing on helping people heal from trauma and family issues. Well, that kind of sent me reeling for a few moments. That's not anything I've ever encountered in the IFS world. And it was pretty clear they didn't understand that in almost all situations where someone is stuck around a financial plan or a money decision, that it's from trauma and financial and family money scripts. So to my system's credit, that just wanted to take my marbles and go away, we engaged in a back and forth in email. And I explained the work that I do. I explained the qualifications I do. And they apologized that they had jumped to a conclusion without the facts. And I find this really common amongst therapists. I remember when I used to do the healing money issues workshop with Ted Clonsett on site. And that night that all the programs are going and you're kind of at a gathering and you're talking to all the various people. Of course, I'd be the only non-therapist there. And as I would talk, well, what do you do? Well, I'm the money guy. I help with the healing money issues. And I remember once so clearly that this group of 8 therapists I was talking to, one by one, they peeled off and formed another group. They would put this face on me that represented their distrust, their I'm going to use hate for financial people. And this person was no different. They said they'd had many experience where a air quotes financial planner presented to be a fiduciary advisor and turned out to have an alternative agenda to simply earn commissions on financial product sales. Well, I don't blame them for being hyper suspicious of anyone who claims to be a fiduciary financial planner. Almost every financial planner, investment advisor has a fiduciary duty, especially, again, if they're an RIA. If they work for a life insurance firm, probably not so much. But I found him to be in pretty good company because it's just a daunting task for a consumer to fully understand whose side their financial advisor's on, even when they say they have an obligation, even when they say, I'm a fiduciary. And the really sad truth is that most Americans believe they already receive objective fiduciary financial advice. The overwhelming odds are that they don't, especially if the advisor has a conflict of interest over how they're paid. And this can be hard to ferret out. And if you don't, in some form or fashion, write a check or see an exact dollar amount taken out of your account for financial planning fees, then it's almost a slam dunk that your advisor has a conflict of interest. And even if you do pay a fee, it doesn't mean that they are not receiving commissions from the investments that they're putting you in. So that's why it's so important to really find a truly fee-only financial planner that receives no income from product sales, meaning that they're free of that conflict of interest. And I read a story in a Bloomberg article that was done back in 2017 by Ben Steverman. And he talked about a lady, Susan, who is a 70-year-old retiree from a pharmaceutical company, and talked about how she hired and fired 3 different planners over 20 years. And one sold inappropriate investments, another put her into funds with backloaded fees. The third said, I'll just charge you $500 a year. And she thought she had a fee-only planner. And finally, she figured out she was paying thousands of dollars in commissions. In fact, a study done in the same year by Bob Veris said the average fee and commission planner that's really treating you right, because this can go much higher, really treating you right, when you look at their fees and the mutual fund fees, earn 2.28%, while the fee-only advisor earns 1.4%. And again, I want to stress, you're paying 50% more if they're treating you really right. And this lady was quoted in this article saying you have to keep watching everything. You're really vulnerable. Nobody really had my interest at heart, even though they were all fiduciaries. Another law professor at the University of Nevada in Las Vegas said there's an ever-present incentive to betray your client's interest. So this is what we're concerned about. This is what we want to look out for, and you've really got to do some work. I'm thinking of another study that I've written about back in 2008. Researchers sent a bunch of mystery shoppers into 284 Boston area financial advisors. What they discovered was only 2.4% of advisors approved of a low-cost, diversified portfolio with no commissions. 85% recommended making a change because the person walked in with this phenomenal portfolio, said you need to make a change into something that has higher fees. And the other shocking thing is that as a client, you very rarely know what's going on or how much all this is costing. And even when they were shown the data, 70% of people said they'd use the advisor to invest their own money anyway because of the relationship. So is this emotional? Are there any emotions going on when I find out that my advisor is charging me hidden fees I didn't know about, and services that cost 50 to easily 200% more than what a fee-only advisor would charge, that I still say, I like him. I'm going to stick with him. I trust them. I mean, wow. Talk about trailheads. Talk about a fear of conflict of a part. This would be very reminiscent to me of a type 9 Enneagram person that would prefer to put their fingers in their ears and just sing la, 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 la. And I'm not picking on just type 9s, other types do this, and we all have this energy in us. There was another study done. Oh, I know, it was the Money Guy. I think he has a podcast. And he said this in January of 2023. How do financial advisors make money? And he said that it was worth noting that the fee-only model is relatively rare in the financial industry. Only 2.5% to 3% of financial advisors are fee-only, meaning 97% of the industry receives some form of commission. That's pretty stunning. So how do you protect yourself? How do you find out if a financial advisor is fee-only and is free of conflict from compensation? I think the best thing that a person can do, and I've been writing about this for, I'm guessing about 10 years, is ask the advisor to A, provide a written and signed one-page statement that they're a fiduciary and will act in your best interests. And most importantly, number 2, either on the same page or another page, have them disclose what the earnings, what the revenue was of their company last year, and how much of the revenue was from just fees and how much of the revenue was from the sale of commission products. And this is a little safer than asking them how much of their compensation comes from the sale of commission products, because there's all sorts of ways of hiding this. I know of organizations that will say all of their advisors are salaried, and yet the organization itself derives a good amount of revenue from the sale of financial products. And what they can do is just refer, if they're truly compensated by salary, there's incentive for them to refer to the departments that sell the stuff, sell the financial products. And sometimes this is how they're bonused, or all sorts of things that are not necessarily commissions. So the safest way is to ask how the company derives its revenue and what percent is from commissions. Obviously, if the advisor refuses to sign either, or just says, I can't do that, I can't find that information out, you don't pay me any commission directly, I get it from the company. I actually had an annuity salesman once tell me, I said, well, where do you think the company gets the money? He says, I don't know, it's none of my business. OMG, right? So this is simple. When you're dealing with a financial advisor, ask them to sign a statement. Do they have a fiduciary duty to you? And most will say yes. And what percent of their company's income comes from the sale of products? I would suggest to you, if it's 90%, you need to run. If it's 1%, you could be like one of my good friends who charges a fee, say $15,000, and will sell a person like term life insurance, and then take that commission off the fee. That is super in integrity. That is fiduciary without a conflict of interest. You won't find almost any advisors doing that. So find out if they sell something, probably you're not going to have an advocate. And that's super important. Thanks for joining me.